What's up, you guys? Roger here. Got a really special video for you guys today. So I just finished watching Barry Habib's 2021 forecast. Barry Habib, if you don't know who he is, he's one of the 4 known experts in mortgages, real estate. So look him up. He's been on CNN, NBC, all that stuff, Fox News, and given accurate predictions over the years. So I am part of his mastermind, inner circle, whatever you want to call it. And he just finished an hour-long presentation of all the trends. He broke down all the trends. So it was an hour-long presentation with a lot of information. So I'm going to try to keep it under 10 minutes. Okay, so I'm going to compress everything, bring all that information to you guys in the next 10 minutes and tell you what to expect in as far as mortgage rates and housing prices over the next couple of years. Okay, so if you're a first-time home buyer or if you're a homeowner, this video is for you. So let's just jump right into it. All right, so the first thing we're gonna look at, because this affects home prices and mortgage rates, is the stock market, okay? So he quoted Sir John Templeton. I talked about this in my last few videos, but let's talk about the stock market. Stock market, and according to Sir John Templeton, very famous, successful investor, bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria, okay? Euphoria is when like everyone's in the market, everyone has money in stocks. As you guys have seen recently in the news with the GameStops, the Robinhoods, all that stuff, there's so many people in the real estate market. So there's actually a level of euphoria done by Citigroup. So they see how euphoric the market is. So basically this little range between the red, the top is euphoria, okay? So this was the euphoria in the stock market back in the 2000 bubble when everything crashed. This is where we're at now. So again, we don't know exactly when the stock market could crash, how much it will crash or correct, but you're seeing it now. How many people are talking about Robinhood? How many people are talking about GameStop? How many people are talking about the stock market? So once every single person, you know, when you go to your barbershop, when you go get a car wash, wherever you go, you hear people talking about stocks, what they're investing in. They're talking about symbols, et cetera, et cetera. That means there's way too much money in the stock market. It has to correct, because if everyone has money in the stock market, how will it go any higher? It just can't. It has to correct, it has to come back down. So basically the first thing that we're expecting is a stock market correction, crash in the coming years. In the next, when I say years, I mean 12 to 24 months. No way to know exactly when that's going to happen, but that's what Barry Habib is predicting. So right now, stocks keep going up. There's optimism because of the vaccine, and interest rates are starting to go up. Okay, so we're not in the below 3% territory anymore. We're right at 3, 3 1/8, 3 1/4. So rates are starting to go up. Okay, so that's what's happening right now. With the stock market correction, with the stock market crash, rates will get better. Okay, so that's the first lesson of this video. Lesson number 1, in the short term, rates are gonna go up in the next few months, but they will continue the downtrend in the midterm. So in the next 6 to 12 to 24 months, we expect rates to come back down. So the lesson here is, if you're gonna do a refinance, if you're buying a home, don't pay points. Do not pay points to get a lower interest rate, because there's going to be a really good refinance opportunity in the coming years, in the next 2 years approximately. So don't pay points. Lesson number 1. Okay. The stock market is too expensive, and here's some reasons why. So it's going to have a pullback. We don't know when, but the stimulus is keeping everything going. Stimulus money is obviously going to keep the stock market rallying. The vaccine euphoria, everyone's excited. And then turning Japanese refers to basically keeping rates really low. You know, so Japanese, Germans have all kept interest rates low for a very long time and continue to, you know, quantitative easing where they're printing money. So we're kind of going that route. But anyway, it's due for a correction. So moving on, Janet Yellen, Secretary of State. I'm not going to get too much into that. Really quickly, we're just going to talk about the Fed funds rate at 0 are different than interest rates. So this is something just very simple to keep in mind. If you're a consumer, even if you're a real estate agent, mortgage broker, whatever, just because the Feds keep rates at 0, it doesn't always mean interest rates are going to be lower. So there's certain times where you see the Fed's funds rate stays the same, goes up here, but then the rates go down. Stays the same, rates go down. Anyway, they're not directly correlated, bottom line. So just keep that in mind. So now let's shift into the real estate market. So obviously we know the real estate market is red hot, okay? So it is going to continue, okay? The red hot real estate market is going to continue. I'm going to explain to you why per Barry Habib. Okay, so these are the births by generation. So Gen X, millennial. So basically we're seeing there's moments here where births are rising here, and then again right here. Okay, so what does this mean? Basically, according to Zillow, the median age for a first-time homebuyer is 33 years old. Okay, so 33 would put you at right in this area. And as you could see by this chart, there are more 33-year-olds, and it's only gonna go up. As you see, there's just more births. So that means first-time homebuyers are gonna increase in the coming years. As you could see, the births, if you're born in 88, 89, 90, you're about to reach the first-time homebuyer stage. And first-time homebuyers are the biggest movers in the real estate market. And I'm gonna tell you why. So if you have someone who is in their 40s or 50s, right? So, there's that sector of home buyers where they sell their home and then they upgrade, right? So it's not really making a difference in the inventory because they buy a house and they sell a house, okay? So it's a net zero. Whereas a first-time home buyer buying a house, taking one more house off the market, taking one more house off inventory. Okay, so that's why first-time homebuyers can shift the real estate market so drastically because they're taking inventory off the market. Okay, here's household formations. Okay, so if we go back to 2002, household formations versus new homes being built. The blue bar is a new first-time homebuyer creating a household, getting married, having a kid. The orange bar is a new house being built. Look in 2002, way more houses being built than families being formed. And that's kind of the trend. Look at this, 2006, way more houses being built than families being formed. It starts evening out, but look where we're at in the recent history over the past 5 years. Builders are not able to keep up with first-time homebuyers. There's almost twice as many home buyers, households being formed than houses being built. And we're seeing it right now. There's not enough inventory. There's not enough houses. A house comes on the market and there's 15 offers. This is only going to continue because of what we saw in the previous chart. Okay. As we can see, there's going to be more and more households being formed, not enough houses to keep up. So this is part of the reason why the real estate market is going to stay hot, and that the reason why we're not in a bubble. Okay. And again, COVID slowed the new construction. So again, less inventory, more buyers, home prices are going to continue to go up. And again, just one more chart to kind of support why home prices will go up. All-time low vacancies. That means if I own a house, I own a rental property, okay, chances are I don't have vacancies. I'm constantly have a renter in that house. So if there's no pressure, like for example, if there was, if I had a rental property and it sat empty for 6 months, then yeah, I might be pressured into selling it at a lower price. But if I'm constantly having renters in there, there's no pressure for me to lower my price if I'm selling that home. So again, one more thing that's going to support increased home prices. And again, look at the chart here. Wow, look, in 2007, there was 3.7 million homes on the market for sale. Today, 1 million. I mean, holy crud, guys. 2 million, over 2 million less homes for sale. So we looked at the chart before. Increased number of births, increased number of first-time home buyers, and 2 million less houses for sale. So look, number of households in America, So I don't know, he wrote here that there's 8 million more households. I'm counting 12 million more household, but almost 3 million fewer homes for sale. This is going to drive the real estate market. So if you're a homeowner, congratulations. You're going to see your home value go up year after year. They're predicting between 7 and 10%. Okay, so the next issue becomes, hear people talking about forbearance. Oh my God, the forbearance is gonna, screw everything up. Well, unfortunately, actually, the forbearance isn't going to have as big of an effect as we think, according to Barry. And the reason is most people with these forbearances, once some people took the forbearance when they didn't need it. Okay, so they're not people who are in financial trouble. Okay, so before the forbearance, they were fine. After the forbearance, they're gonna be fine. And the other thing is the forbearance, once you're done, right, and you're done with the forbearance, the bank is essentially creating a loan. Let's say you missed 3 or 4 payments, you owe the bank $12,000. That $12,000 is a silent loan, no interest, no payments. So there's not this shock of once we get out of forbearance, our payment's gonna go up $500. It's just not the case. So it's a 0% loan. There's no payments due on it. So essentially, with all the equity that people have, this is not gonna be a concern at all. And then look at where we're at with equity in our country right now. Okay, check this out, guys. The average loan to value in America right now, so what people owe on their homes versus what it's worth, is 51%. So everyone has a ton of equity. On average, homeowners have $200,000 in equity in their homes. 87% of people are below 80% LTV. 95 are below 90%. 37. So again, this kind of cushion, there's no reason to fear some kind of bubble bursting because there's too much equity in people's homes. Versus if we look at what was going on in 2009, we're gonna see here, a quarter of the population who were homeowners owed more on their homes than it was worth. We are nowhere near those levels. So if you're expecting a crash like 2009, forget about it. It's not gonna happen. Okay, so the last thing we're gonna talk about is the affordability myth. So a lot of people are, the home prices are going up. They're too high. Home prices are too high. We cannot afford it. We cannot keep going at this pace because no one's gonna be able to afford a home. Wrong. That's not true either. And we're gonna dive into the numbers right now and kind of explain why that's not the case. So here's people, unsustainable, we can't keep up these prices. Here's why we can. Okay, so let's look at a mortgage payment a year ago was $1,000 a month. And to qualify for that, you had to make $5,000 a month in income. 10% rise in prices, 10% rise in payment means you have to pay an additional $100 a month. So in order for you to afford, right, we're talking about affordability, for you to afford that payment, you need to make $100 more a month, right? You have to make $5,100. That's only a 2% increase. Okay, so that means to go from $5,000 a month to $5,100, you have to get a raise or a pay increase of 2%. Okay, pretty normal. If you're at any decent job, they're going to give you raises. They should be raising your, salary at least, or hourly at least 2%, and that'll keep up with the prices. So again, a 10% rise in prices does not mean it's going to be all of a sudden become unaffordable because your income only needs to go up 2%. Okay, we're going to look at a quick example here. Q1 2020, Q1 2021, and home prices went up 10%. So we see here, 300,000 home is now 330, 30,000 more, which means you have to get a bigger loan, but rates went down. Rates went from 3.75 to 3. So rates went down 0.75%. That means your mortgage payment only went up $2. Yes, your mortgage insurance will be $10 higher. So that's a difference of $12. Q1 versus Q2. Simple math here, guys. Your payment is only going to be $12 a month. So it's not some crazy, unsustainable affordability myth going on. It's just not the case. So that wraps up this video. So basically, here's the key takeaways. Home prices are going to stay super hot. So congratulations if you're a homeowner. If you're a home buyer, get in the market so you don't miss this appreciation, okay? So that's number one. Number two, stock market will be crashing soon, sometime in the next 2 years, or some kind of correction. We don't know exactly when, but we expect rates to come back down. They're on their way up right now. Rates are going up. They went from in like mid twos, high twos, now they're a little bit over 3. So in the short term, if you're gonna refinance or if you're gonna buy a home, don't pay points, okay? Don't pay points, take a higher rate, because there's gonna be a refinance opportunity coming in the next couple of years. And the affordability myth that we can't keep sustaining home prices going up at this pace, it's just not true. We just went over the numbers here. So that's pretty much it. Thank you so much to Barry for bringing us this information. And I try to keep it as quick as possible, but it looks like I'm in the 15-minute range. So I apologize that it's so long, but this is really, really good information. If you're a first-time home buyer or homeowner, this is really good to know. Subscribe to my channel. If you want to keep seeing updates like this, please subscribe, hit the bell, hit the like button, help my channel grow so I can reach more people, reach more first-time home buyers. If you are a first-time home buyer, links are below. Click the link, schedule a call. We'll be happy to help you out. We do mortgages in California and real estate in Southern California. So if you fall into that bucket and need some help buying a home, give us a shout. Thank you guys so much, and I'll see you next time.